Welcome to Looking at the Markets with David Modell. Today's topic is why I buy vertical option spreads instead of calendar spreads. These are both very popular choices, vertical spreads and calendar spreads. So let's talk about the similarities and differences and why I prefer one over the other. Let's do a quick review. When buying calls or puts, I often like to make it a spread by also selling calls or puts. This helps to reduce the cost of the calls or puts, and it can also reduce the negative impact on my account if the trade goes against me for a while. Now, in a vertical spread, you're buying and selling the same number of options, and they have the same expiration date. The only difference is the strike prices. Personally, I prefer to buy an in-the-money option and sell an out-of-the-money option. Now, in a calendar spread, you're buying and selling the same number of options, just like with the vertical spread, and the strike prices are the same. However, the expiration dates are different. Typically, you would buy an option with more time until expiration. That's a longer dated option. And you would sell an option with less time until expiration. So typically in a calendar spread, you're buying a longer dated or further out dated option. And then to offset the cost, you would sell an option that's shorter dated or a shorter time until expiration. Well, here are some reasons why I prefer the vertical spreads over the calendar spreads. First of all, vertical spreads are simple. Whenever possible, I like to keep my investments simple. Calendar spreads require you to think in terms of two different time periods because you're dealing with two different expiration dates. On the other hand, with vertical spreads, the end date for your trade is perfectly clear. You're only dealing with one expiration date, and every part of your trade is geared toward that date. Yeah, so when you buy a vertical put spread or a vertical call spread, it's kind of like a coupon. It has that one expiration date. You don't have to think about, well, the call that I bought has this expiration date, but the one call that I sold has this other expiration date. You kind of have like this time warp thing going on with calendar spreads. With vertical spreads, you keep it simple. One expiration date, you can mark it on your calendar and keep it simple. Here's another difference. Vertical spreads let you buy in the money and sell out of the money. Remember, with vertical spreads, you have two different strike prices. With calendar spreads, you do not. I prefer to buy in the money options, which I consider to be higher quality. I really like the in the money options when I buy, and sell out of the money options, which I consider to be lower quality. And I'll explain that. If you have experience buying in the money options and out of the money options, I'm sure you've noticed that time decay really hurts out of the money options much more quickly than in the money options. Okay. And so for that reason, I prefer to buy options that are in the money. And if I'm going to sell an option, I want to sell out of the money options because I want the time decay to have a really strong negative impact on those out of the money options that I'm selling. So that's why I buy in the money and sell out of the money. And this is possible with vertical spreads, but it's not possible if you only use calendar spreads. If you only use calendar spreads, then the strike prices of the bought and sold options would need to be exactly the same. Yeah, so with calendar spreads, if you're just using calendar spreads, then you can't buy an in the money option and sell an out of the money option. That's not a strategy you can use, but you can use that with vertical spreads. And here's another difference. Calendar spreads can be disappointing. Sometimes in life, you get lucky. You buy a call spread and the market goes up a lot in the next few days, or maybe you buy a put spread and the market goes down a lot in the next few days. That's nice when that happens, right? Well, with calendar spreads, the results can be disappointing if the market quickly goes the way you hoped it would go. Profits can be minimal, especially in the beginning. The benefits of calendar spreads often are not realized until later on, when the option that you sold expires, and that could be months away. On the other hand, vertical spreads are often a better choice if you're not planning to hold your position until expiration. Personally, I prefer to take profits and liquidate or get rid of my option spreads long before the expiration date. So here's the takeaway. I like to keep my option trades simple. I prefer to buy in the money and sell out of the money options, and I try not to hold onto my option spreads for too long. For these reasons, vertical spreads are my trade of choice over calendar spreads. So I hope I built up a good case for vertical spreads over calendar spreads. Not to say that calendar spreads are not a viable option. Yeah, they're great and they're fine. But I'm just letting you know my preference and giving you something to think about. So if you'd like more help with options, stocks, trading, investing, or finance in general, please feel free to contact me by email anytime. My email address is davidmodell@gmail.com. If you like this video, please, by all means, give it a thumbs up. Leave a comment in the comments section and subscribe to my channel if you'd like to get updates on the latest videos and educational materials that I'm putting out for you. Thanks a lot, and I really hope to hear from you soon.